All right, traders, welcome to today's market recap. This is Christian from Tribeca Trade Group, and it is Monday, March 14th. Everything that we're going through is for information purposes only. You could read the full risk disclaimer here. Everything we're talking about is for education purposes only. So let's get to today's price action, which was really ugly way to start the week. Once again, very typical of what we see in bear markets, which we've been talking about for a while. And, if it feels like a bear market and if it acts like a bear market, regardless of like the formal definition of a bear market, it is a bear market. So for example, futures rallying a little bit to start the week, and it was pretty short-lived. Right, so we will go through the price action, but the S&P was down. I mean, not that bad of a day for S&P. One of the things that I said earlier, because for a while the S&P was basically around flat for the day. It was just kind of odd to see some of the sectors that were leading, and you could see I've got one of them highlighted here, which is financials, which were up 1.25% for the day. So, a little bit of an odd day, but I think the overall numbers are telling to see what the Qs did today, which again is leading to the downside. The small caps joined them today, which was a little bit different, right? The small caps have been holding up pretty decently over the last couple of weeks. The chart pattern does not look good in IWM, but the last couple to last few weeks have been decent in the small caps. So they got hit today. They were both down. IWM was down 2%, and then the microcap ETF was down 2.3%. Also, a big move in bond yields. That's not helping the situation. I'll go through some of these charts, and then we'll talk about just some of this red here. But bottom line is, before we go through the technicals, and I do want to highlight and give you guys a couple levels to watch, which we talked about in the macro. We talked about in the macro video, and we've been talking about them for the last couple weeks, and I'll expand upon that. But here's the market breadth. Once again, this is now, I'd say, like 4 out of 5 days we've been seeing just the breadth like this, and even when we start the day, it just is not looking very good. Here's the Qs price action, just as a quick recap, just to sum things up for a little bit. But look at the moves that we've been seeing. I mean, they're pretty dramatic, right? We've only had, this is going back to 222, which is as many days that Bloomberg will let me see in just one screen. But how many days have we had where we haven't moved 1% in the Qs? 2 in the last 3 weeks. We've had, a bunch of, a couple red days there, a couple green days, good rally days. And then 2 weeks ago, there was only one day that was basically where the price action didn't move that much. And only one day last week where the Qs were down about 0.5%. But, again, what stands out to me is, just something that I've traded through over time is when you are in a bear market, you can have these really big green days, but what happens is there's sometimes you get a couple days of a rally, and then the trend resumes down. So you can't get fooled, in my opinion, by the up days. And I thought it was possible that we could actually get some follow through the following day, because sometimes the bear market rallies last more than one day. But just really representative of what you normally see is you can see these big rallies, and then there's not much follow through in a bear market. So the price action has been very typical of that, right? And I've got behind the screen here Coupa Software, which was another darling of the software name, and it just gives you another sense of the stock was down almost 10% today. And look at it go down. It's down to $65 here after hours. So their guidance was really weak, right? There's a reason why they're down this much. Look at their future, their full year 23 adjusted EPS, 15 to 19 cents. It was supposed to be 74 cents, right? So again, it just shows you right now, just because, and I think, and I'm not picking on anybody, but I think a lot of, younger, newer traders out there, and, this is no fault of your own. Sometimes you just have to kind of go through this, but, some of the things that we've heard about, hey, buying the dip and so forth, this is just another example of one that, never really gave you any type of buy signal, Coupa software. And I remember trading this. Even look at the volume today too, before earnings. So, perhaps the writing was on the wall. But again, here, a lot of people talk about, like, what helps you in this market, and just even something as simple as what I have, the moving average that I have, the thickest line, the 200-day moving average. Stock was at 288. Right? If you use that as your point of exit, forget about what you think and what about, and think how much about a company, right? The 200-day moving average, the break there, 288, if you got out, or even if you got out a little bit lower than that, right? Maybe you waited a little while, a couple of days to see if it would retake the 200-day moving average, right? Since then, it has made several attempts, and these are also, you could be referred to as bear market rallies, right? Because you're under the 200-day moving average. But look at this. I mean, the stock's down to 66. I mean, guys, so that's really how you avoid losses, right? And that's why people use the technicals. And of course, I use other things, like you hear me talk a lot in these videos about value areas, right? And you hear a lot about things, if you're not using like the market web's value areas, that, that's fine, but you probably heard things about like anchored VWAPs too, and those things. But I'm telling you, just something as simple as a 200-day moving average from to help you limit your exposure, unemotionally kept you out of this big loss, in this name. And that's the story. And, this is just one example. I try to bring out these examples as much as possible about learning. And, I was talking about this weekend too, not to kind of get off track here, but I find these are good examples. And this is one where it's not a tech company. And immediately somebody said to me on Twitter, they're like, hey, well, this is not a tech company, but it's the pattern. So you could cover up the symbol, right? This is Peabody Energy, but it doesn't matter, right? This is sometimes what happens after you have a big decline, right? You don't just bounce right back up. You actually go sideways for a while, right? And notice, you notice where the moving averages kind of confirmed it for you. Also, the move out of value here too, right? Like I said, I do use value areas, and that's really nice confirmation. This broke the 2021 value area, but also notice the price got above all these moving averages too, right? So that's your confirmation. So you don't have to, and the reason why I put this chart on Twitter on Sunday is just because I see so many bad things, and we don't want to call out every time someone says something bad, but it's important to kind of see what the normal pattern is after a stock declines a lot, right? Because there's still too much of, oh, well, I have a 5-year time horizon, right? And that's not an excuse to be taking losses that you have a longer time horizon, right? You want a signal to go long. So again, not a tech stock. And again, this is just one way that it could go. It doesn't have to go like this, but I think the majority of times where I see a big decline in a stock, and you've got such a a washout like this, $45 down to $2. It stayed in that range of about $2 to $3, right, for over a year, right, and then it began to climb out of that, right. So again, what I'm illustrating here is the pattern, not so much the price, not so much the stock itself or the industry that it's in, just the pattern of what happens after a name is in a big big monster decline. It usually will go sideways for a while. And psychologically, why does that work sometimes, right? Because if it goes sideways for a year and a half, people lose interest, right? When people lose interest, right, all the sellers are basically gone in the name. And then if the company, and if there is a theme that's positive that takes place, right, then, people will start to add money back, and you could see the volume, right, picking up in this name, right? And that will tell you as well, right, that there's now more interest in the name. So let's get back to the S&P. I mentioned that I would talk about, some things here in terms of the technicals and the price action, but here we go. I mean, this is tricky. This is another fake out, and I got faked out. I'll show you my trade blotter today. I did not have a good day today. I did not do what I see a lot of people doing, and I applaud them for shorting rallies right now in this market, because that's how people are making money. For now, it's just, hey, taking these bounces and just realizing that this market environment is too difficult, and being able to kind of short some, take these weak bounces that we're seeing, and taking advantage of them and going short. Right, so that was the move till about 10:55, which is a little bit different than what we've seen, a little bit different pattern. So that's why I think it was also a bit tricky, and why I got caught in a trade today. And then we just started to see things kind of melt. So 1 hour chart, we did start the week in value. We're now below value. What's again, like the S&P, just, it doesn't for now, and this could come later in the week. We don't know. It's been certainly going this way, but the S&P is just continuing to not break, right? It has not broken last week's lows, and it did not break the lows from, what is this, January 24th. So it's still hanging on by a thread, I would say. Not January 24th, February 24th. Sorry about that. Now, if we do break that, what I've been watching, and I'm just kind of saying, let's get it over with already, right? We've talked about the 80% rule. I sent this chart over the weekend. I've sent this chart now out like for the last 3 weeks, but I think we go down to 40.71. That would mean the 80% rule is complete. Again, if you're not familiar with what the 80% rule is, it's when you start a period, right, either above the value area, and this is the value area for the year, right? Either you start above or below, and you break into the value area and you establish yourselves there firmly, there's an 80% chance that you go all the way through to the other side of the value area. So we're almost there. And that's kind of what I want to see. Now, again, is it 100% guarantee? No, 80%. So there's a 20% chance right now that we don't get to the bottom of value by the end of the year. But that's kind of what I'm thinking, is that we could get down there. And I think from a more of a positive, just to kind of plan things out, I think sentiment is starting to finally get a little bit washed out, right? I think we're on the way. I was looking at the BOFA bull and bear indicator, which comes out once a week on Thursdays, and it's not quite in a buy signal, but it's getting closer, right? I think their indicators like a dial, and I think below 2 or something like that is a buy signal. I think it's at a 2.9, so it's been the lowest it's been. Also, we were talking about this weekend the Citigroup market sentiment, which is almost in panic, right? It's been in neutral for a while. And I prefer those a lot more than the CNN Fear and Greed Index. I don't particularly like that. I don't think it's a very good model, but that's what I'm looking for, right? And the other thing that we've talked about is the Qs are weaker and they have more of a distance to fall, right? And they have been falling. That level is 12,667, or if you want to level in the Qs, right? Because I know a lot of people tend to look at the Qs. That's around 297.75. Right, so that's like a decent portion down. Now, again, it doesn't mean that we get there in a straight line, but the 80% rule is in effect. Again, it doesn't mean like we go right down to the bottom, although we have been moving quickly. We could do a bounce and then we can get down there too. So that's what I see. And I continue to try to trade this market a bit lighter. I was holding on to some commodity plays. I was a little bit worried, and you've heard me talk about this, that all these commodities are tending to move together. So it's not like, hey, you could take your money out of the oil trade and go into the palladium trade or go into the gold trade, right? They've all been acting the same way. In fact, one of the charts that I showed in the TTG macro video this weekend was gold, right, and oil. Right? Can you tell the difference? If I covered up the symbol and the prices, would you be able to tell me which one is oil and which one is gold? Maybe you might. There are some differences, but bottom line is what I'm trying to illustrate here is that they're moving together. right? And as well as about 5 other commodities too. So, you know, it's tough to have a couple trades on in this group, even if it's in a couple different commodities, because they're all moving together, right? And if you kind of caught the down move in these, you know, it may have been a little bit painful for you if you've been hiding out in the commodity trade. Metals and mining was down 5.7% today. Right, that's another group that was just acting very well towards the end of last week. You know, I think U.S. Steel, Cliffs, which continue to see call activity, weren't down that much. U.S. Steel was down 3.4%, but still a lot more than the overall market was. Nucor was down 2.4%. Tech Resources was down 7%, which has been acting very well. BTU was down. This also looks like the gold and oil chart was down 14% today. So a lot of, you know, there's not a lot of hiding places right now in this market. Cash is it right now, right? What else? And then there's just a couple other things that are just so dramatic. The Chinese internet ETF, you know, I have to mention this in this video because how can you not? When have you seen something like this before? In the last 3 days, about a 30% move. I mean, to the downside after already moving down, you know, in a dramatic fashion this year, right? So, I mean, this is just crazy. To me, anyway, a 30% move in 3 days, that's a crash. Um, so it's remarkable how some of these things are going and how bad the emerging markets are looking, even after they kicked out Russia, you know, out of this ETF. I mean, so this tells me when you've got situations like this that are just going down this fast, what I did was, you know, here's the trade blotter for me, you know, it was just to kind of take some, and I screwed up a day trade in here pretty badly. I was looking for a little bit more follow through. I saw the move out of commodities, and I was like, okay, maybe they're going to actually move a little bit into growth. Keep in mind that we've got a major index rebalance coming on Friday. Both the Nasdaq and the S&P indices rebalance their quarterly rebalance on Friday. So I was like, hey, that would make sense to me. A little bit of a move out of commodities and a move into growth. That did not work. And it was a day trade, but I lost some money on it. And I tried to buy the dip in Alcoa today too, and it just looked like it wanted to keep dipping, right? And then besides that, just you know, a couple agriculture trades I've been in, CTVA, which still was a profitable trade, and ADM. I took one profit target higher, and then I got out of a rail name, which just I added to it actually last week. Just wasn't working. So you know, if trades are not working, right, and they're not doing what you originally thought that they were going to do, I've just kind of wiped the slate clean. And this week, to me, even as I said, and I try to practice what I preach as well, this week is not a great week to be heavily positioned with in my opinion, anyway. You know, you could certainly set up a couple option trades for catalyst type moves for the Fed meeting on Wednesday, but you got a big unknown, and you got to think about what the institutions are going to be doing, right? Because they're the ones who do drive the market. Are they wanting to be heavily positioned into this Fed meeting on Wednesday? I don't think so. And then, of course, like I said, on Friday, you're going to have, you know, one of the biggest volume days of the year on Friday because it is quadruple witching, right? You have your index futures expire on the open. You have a normal monthly option expiration, and then you have a huge quarterly rebalance for the S&P and Nasdaq. So this is more of a week to kind of, maybe I should have done this more at the end of the week, but that's okay. Getting out of just a couple swing trades here, and now my cash balance is like 95% in my trading account, which I haven't been that way in a while, but I don't see much edge considering the price action that we're seeing, plus the events that we have this week. Usually I do like to stay in a couple swing trades as long as they're working, right? But I just decided to kind of bail on a bunch of things. All right, so we talked about that. Another story too, besides the emerging markets, is what's been going on with this with these growth ETFs. This is the IBD 50, right? And if you look at my spreadsheet here, which has the year to date, I mean, this is bad for the IBD, but it's not. If you look at some of the other funds like this this ARK Innovation, which I know everybody talks about this one, but here's what happens when you stick to your guns and when you don't adjust to this market. The performance, if you stay wrong, right, and stick to your conviction without making any adjustments to the market, then you can expect to have, not always, but it can happen where you can be very wrong if you don't make adjustments, right? Down almost 50, down over 40, I was gonna say almost 50%, but it's got to get over 45 for me to say that. Down 44% in a couple months. In a couple months, no options, just stock. Unbelievable. And I'll tell you, I've had conversations with numerous people about it. Oh, they're filling a niche or whatever. No. Listen, if you want, I mean, there's nothing that says in an asset allocation model that you have to stick and you have to have a certain amount of your money in high growth and say, okay, I've done my job well. That is not doing your job well. Even if you are trying to do an asset allocation model, there are better ways and there's better things for you to do once, in knowing that when something breaks a trend, you get out of it. It doesn't matter if you've got a long time horizon or not. If something doesn't look good, you don't stay in it just because you're saying it fills a void. Really, really bad analysis, in my opinion, from talking. I won't, of course, name any names, but so you're happy that you fill a void in your portfolio and it gets blown out 50%. That makes you put a smile on your face. Okay. We're in this as like, either if you're in it for trading long term, you still want to have responsible investments. So let me go from that. So anyway, that's how I see things. We've said for a while that the bottom doesn't look like it's in. You've heard me talk about this S&P chart now for a while, that we've got 3 or 4 bad things going on, right? We're below value. We keep getting rejected at the 20-day moving average. We're making lower highs. So, we'll wait for confirmation for when things are going to be different. And we'll watch how these events unfold for this week, Wednesday and Friday. All right, guys, thanks for watching. Have a great night. See you tomorrow.